Hello and welcome to this week's BizSmart Lunch and Learn webinar. Our weekly webinars are aimed to provide advice and share knowledge amongst business owners on key business topics and specialist areas. This is part of our service to our Smart Room members, and if you're not already a member or a BizSmart client and would like to access our archive of webinars, then please visit our website biz-smart.co.uk and go to the Smart Room page. Our host joining me today is BizSmart founder Kevin Brent. But before we start the webinar, can I ask you all to use the question mark function on your screen to post any questions that you may have, and Kevin will answer them all at the end of the session. Thank you, Kevin. Over to you.
Brilliant. Thanks so much, Caroline. So in this webinar, we're going to take a look at answering, does size matter, first of all, and is growth important to boot? And we're going to look at a simple framework for identifying opportunities for growth with the highest potential and the least risk of failure. So I'm hoping that by the end of this, we'll all understand the impact of size and growth on the potential value of our businesses, and also learn how to apply that framework to identify opportunities and classify them according to potential and risk. So that's what we're aiming to do today. So we've probably all heard quotes like this. So essentially the idea being that if you stand still with your business, you'll end up going backwards because everybody else will be developing, they'll be growing, and whatever else. So that's all fine. There are lots of sort of quotes along the same lines. I don't disagree with that. But also, specifically, both the size of your business and the growth, historic growth and the future growth potential of your business will directly impact the value of your business that somebody might perceive if they were looking to either buy your business or be looking for other options for your exit at some point. So if you've got an eye on exiting your business, which we're all going to exit our business at some point or other, and you're trying to build a business that will give you the best options for that exit, then you need to think about growth as one of the things to help. So to illustrate that a little bit, without trying to get too complicated, when John Warrillow was putting together the book Built to Sell, which is an excellent book about what drives the value in your business. But he conducted research amongst 14,000 businesses who had either just sold or had just received an offer for sale. And he found there were a number of key drivers of value, and one of those was growth, and that's both the past and the future. So he found that the average multiple of net profits effectively that a business owner might receive for their business would be around 3.7, 3.8 times the net profits. But if you ask the question, this is one of the questions that we ask in the Value Builder score assessment, how easy would it be to accommodate 5 times increase in demand in your business, then that multiple changes. Because if you have a business where you say actually it will be impossible to take on 5 times demand. So imagine maybe a law firm where if to rapidly take on 5 times more clients, you need to take on 5 times more lawyers, which would probably be very difficult to do, not impossible, then that sort of business will receive a much lower multiple than, say, a business at the very bottom here that said actually it'd be very easy to take on 5 times demand. So maybe a software company with something that actually is very automated and very simple to just sign up new customers for, or to get them up and running. So a business like that will receive a much higher multiple. And if you factor size into that as well, there's a step change in the multiples that businesses will receive according to the size also. So growth obviously will impact on the size, and typically businesses that are less than £750,000 turnover will receive quite a much lower multiple than businesses that are bigger than that. And there are various step changes upwards from there, around 2 million and around 4 million. But certainly 750,000 is a really quite a step change milestone to get to for those of us that have businesses a bit smaller than that. So the reason that size and growth have such an impact on the potential value of your business is that it comes back to what a buyer is looking for when he's looking to look at your business. And if essentially he's buying your future stream of profits, a cash flow that's going to come out of the business. He's looking at how much it's going to be and how reliable your estimates are for that. So he's going to ask those two questions. He goes, how much profit will your business generate in the future, and how reliable are those estimates? So we can start to actually illustrate that with simple calculation of value that businesses use. And I'm going to use Caroline here just about to cover things off, but because of the idea of net present value might seem a little bit complicated, but it's actually really, really simple. So we're going to start with this business that's going to generate pre-tax profits of £100,000 in a year's time, and then every year for the next 10 years, that's the net profits. Going to nice little, nice reasonable sized business in terms of that. But a financial buyer will look at the rights to that. If he's going to buy, he's buying the rights to that future stream of profits, effectively, and he's going to look at that and decide what he's willing to pay today for those rights. So before you think it's getting complicated, let's just try to count. If I said to you, I'd give you £1,000. You've got a choice of £1,000 now or £1,000 in a year's time. What would you take?
£1,000 now.
Okay. And why would you do that?
Could book a nice holiday straight away.
Okay, but why now? So you
spend it straight away.
You can spend it straight away. So you've got the money in hand. You might also wonder, well, it's all very well, Kevin, you say you're getting me £1,000 in a year's time, but actually, will I do it? Will I still be here? You've got me in the room now. You could force me to give you £1,000 now. But so you've implicitly said £1,000 isn't actually worth the same. £1,000 now is not worth the same as £1,000 in a year's time. Okay. If I said to you, okay, a different choice then, how about £500 now or £1,000 in a year's time? What would you take?
Yeah, I'd wait for the investment for the £1,000.
Yeah, because you think actually it's worth that for another £500. There's I've known Kevin for a few years. He's probably going to be here now. He's probably be good for his word. Not totally convinced, but it's worth that risk for me to do that. And if I kept asking you that, I kept pairing it off, we'd probably get to a point where you'd say, actually, that's about the same. It might be £800, £850, something like that. You'd say, well, yeah, that's about the same now as having £1,000 in a year's time, because you've implicitly said you've done that trade-off, and you've traded off some risk and the time value of money for now. And that's all net present value is about. So if you look back at this business of £100,000 here, if somebody's looking to buy your business and you say there's going to be £100,000 in pre-tax profit coming out at the end of the year, they're not going to give you £100,000, they're going to discount that. And a typical sort of discount rate might be around 15%. That would be quite a generous one. But if they believe that £100,000 is coming, they might say, that's my investor threshold. And if you to get to that 86,957, you are simply dividing 100,000 by 1.15, so the 15% of the 1.15. Now, if you do that for every year, you might do that for the second, because if I say now 2 years' time, you're not going to just divide that by 1.15, because you're going to effectively divide it twice, because that's even further away in the future. There's even less chance perhaps of it actually happening, or you've got to wait longer for your money. So you're going to say, actually, that's the equivalent of £75,000 today. And you can do that for all the years. And then if you add them up, that is what a net present value calculation is in its simplest form. And therefore, the rough value of that business that's generating £100,000 profit for the next 10 years is about £500,000. Fine, that's a flat business, no growth in it whatsoever. If we now take that same business and we say, right, well, that business is going to grow now at 20% year on year. And it's grown at 20% before, so we can make that credible, and the person buying us believes that there's a strong chance that is going to happen. If we apply our 15% discount to those, clearly we're going to have a bigger business in 10 years' time and bigger net profits in it. But the net present value of all those is quite different. And if we add all that up, that's nearly 1.3 million. So you've started with the same business. One business, it's believable that it's going to stay flat at 100,000, which is quite nice. It's still good net profit. But the other business, we were able to demonstrate to a potential acquirer that it's going to grow at 20% year on year. The net present value, or the value that somebody's going to apply to your business, is about 2.5 times the amount. So hopefully, is that clear, Karen? I'm lost everyone. So basically, that tells us that that growth and size are directly linked to the value of your business, and the credibility when you're putting growth figures together. It's not just like, oh yes, well, we're going to grow at 50% a year. It's got to be believable. So the more that you've been able to demonstrate that with your historic growth rate, and that you can then show in the future that you've got plans for how that's going to continue, the more that will have a direct impact on the value of your business. So that's why it's important to look at growth and keep looking at growth. So we know it's important. Now we're going to start to look at a framework as to how to brainstorm, how you can brainstorm in your businesses to identify opportunities that have the highest opportunity for growth associated with the lowest risk of failure. Now this is a matrix that some of you may well be familiar with. It's called the Ansoff matrix. It's not new. It was invented by a mathematician called Igor Ansoff, funny enough, in 1959. So it's definitely not new, and it's very well tried and tested, and it's used by multinational businesses as well as owners of small and medium-sized businesses like us. And it looks at your business from the standpoint of initially what markets and customer groups you're in today. So existing markets, and then still on the vertical axis, what new markets you might think about entering. And then on the horizontal axis, it looks at your existing products and services and what new products and services you might be able to bring in the future. So that's the matrix. And when we talk about markets, it's important to remember that it's not just geographic markets. It might well be new countries, new cities, or whatever else. It might be by geography, but it might be by different types of customer groups. So it could be the demographics. It could be by age. You might have a business where typically you've been very successful in 18 to 24-year-olds or something, but actually maybe you think you could take your existing products into a new segment, maybe for middle-aged women, or whatever it might be. So it's not just geographic, it can be demographic and also psychographic, which tend to be sort of behaviours that people adopt, and also by the kind of interest they have. So it might be people who play tennis or what it might be. However you would typically segment your business, so don't just be limited to think about geography. So the idea here is that it enables us to bring risk into our thinking, because not surprisingly, if you think about it, if you were to focus your attention on your existing customer groups, your existing markets with your existing products and services, those will represent the lowest risk of growth, because you know the markets and you know the customers. And we're talking about ideas that would increase by redoubling your efforts on those. What might you be able to grow? So that is the first place to start, because it represents the lowest risk. There's least unknowns in what you're doing. But then we might look at maybe entering new markets, new customer groups, as I said, but still with our existing products. So we're keeping one thing constant, but we're just finding new markets for their products. So that's a little bit more risky than the first box, because we don't know so much about the new markets or the new customer segments that we're going into. So it'll be a little bit harder to succeed. And similarly, we could look at staying in our existing markets with the current customers that we've got, but bringing new products and services to them. So again, it's just the one unknown. We're keeping one thing constant, and then there's one unknown. And finally, if we don't think there's enough opportunities for growth there, we might look at completely new markets and completely new products. Now, of course, this represents the most risky of those four options. We don't know the market and we don't know the product, so we've got to do a lot more work to make sure that we get things right in that box. So as you think about your business and growing it in the lowest risk fashion, we would typically, or we nearly always, want to start with that bottom left-hand box with our existing markets and our existing products and services. Okay, with those four bubbles. So start with the green, then look at the amber, and then look at the red. So let's just illustrate that a little bit and make that a little bit more tangible. Let's look at a really simple business. I don't know whether, as you were growing up, whether you ever had a little business, but we had some apples in our apple trees in our garden, and my brother and I used to, on the drive, have a little stall and a box, sell a box of apples to people that went by. So we made a little bit of pocket money by doing that. So I'm going to illustrate using that kind of business. So we're selling apples essentially to passers-by. So if we were to do this exercise and think about what else could we do in terms of, if we focused on that and really tried to make that work harder, we might think, can we increase the average amount that each passerby spends with us? What can we do for that? Can we increase the frequency of their purchase? Encourage them to come back a bit more? Can we encourage more people to come down our road? Maybe they're missing our road entirely and going somewhere else. Can we do something like that? Can we encourage more people to actually stop, take notice? It might be that actually we've got a limited supply of apples, so maybe we need to think about where we can get more apples from to sell. So we could look at all sorts of things. So I've just listed a few things here, but we could do bulk discounts. We could put a sign at the end of the road to attract people down the road. We could actually put flyers out to our neighbours and get them to come along. We could find some way of a repeat order type. So there's whole lots of ideas that you could probably think of here that if we were to actually focus on it and redouble our efforts on how we would grow with the same business, basically, there would be lots of things that we could think about doing. Then we might say, okay, well, we could take those apples, those existing products, we could take those apples and we could go to the local village high street and we could take a couple of boxes of apples, or how many we thought we could sell, and we could try and set up a stand somewhere on the high street, or how we might do that. So we're taking our existing products into a new market. But there's a bit more unknown here and a bit more to think about. So it's a bit more risky. I don't know, do we need a license to sell apples on the high street? What's the reaction for the other shops going to be if we, especially if there's a fruit and veg shop there or something and we stick a stall outside of theirs? How do we make sure that we've got enough apples to satisfy the demand there? I don't know how we're going to carry these boxes of apples in there, but if we're successful. So there's a lot more that we need to think about if we're going to do that option versus the first option in the grid. So, and as I said, in this particular case, I've used the example of a geographic new market because we've got to talk about going to a new location. But as I said, it doesn't have to be just geography. It could be that we were selling apples to the teenagers and now we're going to sell apples to the mums, or whatever it might be. So that's that one. Now we might say, actually, we could stay with our existing markets, so we could stay on our driveway, but we could do a few more things with those apples. We could make cider, we can try and sell the cider, we could make apple juice, we could make jam, maybe we could do toffee apples, we could do a whole range of things with apples. And I've just stuck with apples here, but of course actually, we could sell other things, we could do complete fruit and veg or whatever, not that we were actually growing those at home particularly, but we could do it. But I've just kept to some apple examples. But you can see how here there are many more things we could do with our existing customers and markets with different products, and we could do a whole list of it. But each of those is a little bit more complicated than just selling apples in boxes or whatever we're doing. We've got to work out how we make the cider. Again, I suppose, are there any health regulations, health and safety, or whatever? We need to think about that as well. But obviously, there's the taste, getting it right. But apple juice, all the same. And how do we make those? And how do we package it? How do we price it? How do we sell it? All those sort of type things that we don't know. So. But that's a similar risk to the top left box. If we don't think there's enough opportunity for growth in those boxes, we might actually think, okay, well, what else could we do that would be completely new? We've got a real taste for this business now. So we might say, okay, well, let's combine those two and let's make some more products, the cider or the apple jam or apple juice, whatever it might be, and let's take those to the high street. So we're now going into a new market with new products. So we jumped straight there from our bottom left box. That would be a really big step to do. And that's the sort of thinking that we want to encourage and want to go through when we're looking for opportunities for growth. So hopefully that sort of can illustrate, using a very simple business, as to how you might think about different opportunities for growth, and how you might assess to a degree the likely risk of doing those. So what I suggest you do, and we take our businesses through this sort of exercise, what's a really neat exercise to do is just simply ask these questions. So if you start by making a list of up to 5, it can be more, but you just start, and this is a good thing to do within your business with 1 or 2 other people, rather than just doing it on your own. Actually bounce ideas off, stick things on a flip chart or whatever works best for you. But make a list of existing products and services that you're currently doing that you think you could sell more of by focusing extra energy on your existing customers. So start with the product and services and think, okay, what could we do, and identify some things, just like I did with the Apple example. How could you increase the frequency of purchase? How could you increase the average order size? How could you increase loyalty, people coming back for repeat business? Think about those sort of things, and make a list of those. Then make a list of some new markets that you could enter with your existing products and services. And again, remember customer segments. So it could be location, it could be buying behaviours, it could be interests that they do, it could be age, could be sex, could be whatever it is. But think of 5 new markets that you could take that you're not currently serving or selling to. Then 5 new products and services that you don't currently offer. So thinking about the cider, the apple juice, or whatever, but think of 5 potential new products related to what you do in some way or other. We don't want to be operating completely different businesses, but that are related some way to what you do. And when you do that, just state whether the primary customer group that you're going to be selling that to will be an existing group or a new group. So if you've gone through that exercise, you should now have a pretty good list of growth opportunities. So what I hope we've done in this webinar, which is wrapping up really now, is that hopefully we've understood why growth and size matters, why it is important to keep growing, not just to stand still. And we've taken a look at this framework, the Ansoff Matrix, for helping to identify potential opportunities for growth with the greatest potential and the least risk of failure. Of course, that isn't the whole story, because what we then need to do is, we need to take each of those opportunities. So if I was going to say, right, we're going to start making cider now, we'd then have to work that opportunity up much more and look at the pros and cons of it, and work out all the good stuff that we would normally want to do. But this is a starting point to help with that. Next time around in the webinar, what we'll do is we'll actually have a look at how you can start to assess the commercial viability, perhaps, of some of those other opportunities. But what we've done now is identify them by essentially by risk. So that's basically it now, Caroline. So thanks for that.
Okay, thank you very much. You've got a couple of questions coming through. The first one is from Sarah, and she asks, what if I sell a service but not a product?
Okay. Yeah. So I've got the bottom there on that matrix, existing products. So whenever you I say products, read products and services, because this applies equally for a product-based business or a service-based business. So I'll give an example of the apples, obviously, which is product, but it works equally well for a service business. So just whatever your primary business is, just switch product, service. Same thing. Thanks, Sarah.
Okay, thank you. Next question, Catherine would like to know, should I list ideas that I have no plans to act on now?
Okay, Catherine, thank you. So if I understand correctly, just all sorts of wacky brainstorm type ideas maybe. So they want to have some logic to it, so that you could do it. But I would still list them, even if they're things that you don't think you're likely to do. So you might fill that matrix in, and you might still do the top right-hand box, knowing that probably in the next 4 or 5 years, or whatever time frame, maybe 10 years, you're going to concentrate on the other 3 boxes. I would still list those there because they are then there for you to see, and you're constantly thinking opportunities and thinking actually maybe, and you're revisiting those when you need to. But if you ever do talk to a potential acquirer, an acquirer is likely to ask you for these growth opportunities because they may think actually that fits in with what we do, and we could capitalise on those things by buying you. And then the buyer has got an instant way of potentially increasing the growth potential. So they might then apply more. And I literally had this, so the business that we were helping to, that had an acquirer that was interested, and they asked us to do this Ansoff matrix exercise for them in advance. And they asked us for things that, not necessarily that we absolutely got on our plans to do tomorrow, but things that might be done at some point in the future. So yes, I would include them too. It's a simple answer, Catherine. Thank you.
Okay, thank you. Next question's from Laura, and she asks, what do you mean by market?
Okay, all right. Yeah, so there we go. So market, you can typically describe by geography is the most common one that we think about. So could you go into a different location, different city, different region, different country, that way, that's one. By demographic is another, and you might look at that by age, by sex. You might go, I think I said before, you might go for teenagers, you might go for middle-aged people, whatever it might be. So that's another one. And then there are a couple of others, but also by behaviours. You might segment your customers by people that play a particular sport, or are members of particular clubs, or maybe even buy a particular product. Maybe a competitor's type product that they're already buying something, but think about how you might segment your markets, which I would hope most of you have done anyway, or certainly have a good idea as to kind of people that are buying your products and services, and think about how you could think about a different group that you might be able to go to, that you still need to be able to define that group, and you need to be able to identify them. It's no good thinking of a group that you just couldn't actually find. But yeah, so all sorts of different ways of segmenting your group. So when we say market, it's got to encompass all of those.
Okay, thank you. Your next question is from Simon, and he asks, what if we plan to introduce new products to both existing and new markets and customers?
Simon, if we plan to introduce new... Okay, so we're talking about introducing a new product, and it might be applicable to both existing and to new markets. Fine. Well, then here I think we're thinking about what I would suggest you do is to think about who the primary audience might be in the shorter term. So because we are really looking here for things that we might practically implement. So if the majority of sales for this new product service is likely to come from your existing products in the next couple of years, I would put them in that box of existing markets, existing customers. If you think that this new product is going to serve a completely different group from the get-go, then I would put them in the new markets box. But actually, does it really matter what box you put them in? Put them in both if you really want to. But certainly I would focus on them in whatever you think the primary market will be. Thanks, Simon. Any more?
No.
Okay, brilliant.
I think that's it. Good. Thank you again, Kevin, for hosting today's webinar. I will be sending out a copy of the presentation and also Kevin's contact details out to you all very shortly. But before we close, just a quick reminder, this webinar is part of our service to our Smart Room members. If you are not already a member or a BizSmart client and would like to access our archive of webinars, then please visit our website, biz-smart.co.uk, and go to the Smart Room page. That's all for us today. We hope you enjoy the rest of your day and that you can join us again very soon. Thank you.
Brilliant. Thank you very much.